start out, you tell us a little bit about yourself and who you are.
Okay. I am Dr. Charles Evans. I have been teaching economics and finance for the past decade now, after having spent the 1990s working on several online payment system projects. Starting a couple of years ago, I became very interested in Bitcoin as something that looked like they were getting it right this time. Nonetheless, I teach finance, I teach economics, but I'm also interested in doing finance as well.
And I'm Dan Larimer. I'm the creator of BitShares and the concept, and we'd like to talk about that. There's a lot of confusion that I've noticed where a lot of gold bugs don't seem to like Bitcoin. They accuse,
I've noticed that as well.
You know, people that are into freedom say that Bitcoin is no different than fiat money, whether you're Chris Dwayne or some of the others out there.
Mm-hmm.
Major proponents of silver and gold just don't like Bitcoin. And I'd like to talk about why they don't like it, and if there's anything that we can do to try to convince them that it's probably not as scary as they think.
Well, the short answer is I don't know. I do know that James Turk, who is the Goldbug's Goldbug, did come around. So perhaps it's just a matter of time. And another is it might just be that it is a misplaced metaphor. It might very well be that Bitcoin should not be viewed as money first. The underlying protocol can do so much more than just facilitate transactions.
Right. Oh, we've been discussing around here how Bitcoin can be viewed not as a currency, but as shares in a Bitcoin company, an abstract company. And I'd like to discuss, well, what does that actually mean? How can we view it that way?
Well, one way of looking at it is if you look at a statement of cash flows for a firm, and if you look at the statement of cash flows for a government, they're actually very, very similar. Both have money coming in, and both have money going out. Both can borrow, both have to pay on those loans. And if you map everything together, you find that there are these two categories that are not mapped to anything else. And on the side of government, you have the creation of new money, new dollars in the United States, and with a firm, that would correspond with the issuing of new equity that dilutes the existing equity holders' value. And seeing as how each of those is the one missing piece on each side, it's only logical to put those two together and to be able to see fiat currency as being very similar to equity in a government.
So if we view Bitcoin as equity in Bitcoin or shares in Bitcoin, then we have a completely different metaphor. And I think that the people that don't like gold actually probably don't have any problem with stocks.
To the best of my knowledge, they tend to favor companies, yes.
Yeah, companies are well understood. They understand, well, issuing these shares in their company, the shares are created out of nothing, it seems like, and they're backed by the service and products produced by the company.
And they get their value from the expected future value created by the firm.
Okay. So if we are going to compare Bitcoin, governments, and companies, it's really all one and the same thing. Maybe we can learn some lessons about how we can improve Bitcoin.
Whether they're one and the same thing or whether they are analogous is, of course, open to debate, and people would agree or disagree until, the cows came in. But the fact is that you can line them up and you can say, this looks very much like a firm. And in fact, if you go back to Satoshi Nakamoto's original paper, the whole notion of mining, yet another analogy, consists of, if memory serves, a grand total of 2 sentences. And he provides it as an analogy, and yet people have become fixated on this idea of mining as being mining. You don't mine coins, you mine ore, and then you mint coins out of the ore. There is no analogy for that within the Bitcoin world. Then you look at the idea of the units of Bitcoin being digital currency. Certainly that's one way of looking at them, but they could serve as many other things. You need only look at Mastercoin and Namecoin, colored coins, and you realize that the money metaphor goes only so far, and it's only one of several different ways of looking at this thing.
I've been saying for some time with BitShares that we want to take Bitcoin and view it as a company, And when we do that, we realize that we have these miners, and they're providing a service to Bitcoin. That service is securing the network and processing transactions.
Yes.
But if we're going to use this analogy, it'd be like a company paying its employees by issuing new shares in the company.
Yes, that certainly is a viable analogy.
And when a company does this, do they write that off as an expense, generally?
The creation of the shares would not be an expense. It would be simply issuing shares and then using those shares to give to their employees.
Is it transferring value from anyone to pay to the employees?
Yeah, that it would be. It would basically, if you have $1 million worth of equity, and then you have 1 million shares outstanding, you expect those shares to be worth about $1 each. If the people who run the company then, either through an external agency that you could think of as being the central bank, or if they do it internally, which is how a company would normally do it, if they issued another 1 million shares, then you'd have 2 million shares and $1 million worth of equity. And you would expect the shares to be worth about 50 cents each. Mm-hmm. But the people who just issued the new shares would be sitting on $500,000 worth of shares that they could then distribute for goods and services. And whoever is closest to the firm, in the same way as with inflation, whoever's closest to the firm or closer to government gets the shares first. And it is entirely possible that the initial recipients don't quite realize that new shares have been created. And they might accept these shares at approximately the same value as before. As the world catches on to the idea that there is new money and there are new shares in circulation, it becomes apparent that each individual share is worth a bit less, and the last people furthest removed from the management of the firm or from the government to receive this basically receive this money that now has substantially less value, and that just means that prices of other things have risen relative to the value of the thing that they're receiving. So if you're close to the executives of the firm, say that you're the employees getting paid, and then they spend this money very quickly, it is rather like they're getting something for nothing.
I'm going to disagree with you slightly,
mm-hmm.
in that it's very clear that you have so much value, you issue more shares and you allocate it. It might take a while for it to show up in the prices,
mm-hmm.
but you are transferring value from the current shareholders
yes.
to the new shareholders
yes.
By the act of issuing new shares. We've got a business and it's issuing these shares. If we wanted to make the business more efficient so it can be more profitable, it's obviously better if the business has to issue less shares. Then if you know shares and can still get the work done,
right.
It would be the ideal situation for any business.
Right. Well, generally firms do not issue new shares unless there is an infusion of value. It's very uncommon for the owners of a company to go to the shareholders and ask the shareholders to contribute yet more money into the firm. It's an unusual thing. It does happen, but it's not nearly as common as receiving money from sales and paying taxes and salaries and things like this. It's a relatively rare thing. With publicly traded companies, this is referred to as seasoned equity offering, and it is essentially as invasive as an initial public offering. You have your audits, and you have all sorts of filing requirements. You have to write another prospectus. What are you going to do with the money? It's unusual. Now, this is not to be confused with a stock split. A stock split would be where people held one share on one day, and the next day they woke up and they held 2 shares. The 2 shares would represent the same value in the equity account, so the shareholder has the same dollars worth of shares. It's just that the person has fewer shares. That's not how inflation works. Mm-hmm. Inflation is not where somebody from government comes and just adds an extra zero to every dollar bill in your pocket. It's somebody's getting the new money first, which is not the same as a stock split. The stock split hits everybody evenly all at once.
All right. So let's talk about some other properties of shares. Normally shareholders get to elect the board, and they are ultimately the ones that, in addition to sharing in the profits, control the company.
Yes, that's referred to as common shares. And common shares have votes with no guaranteed dividend. There might be a dividend, although that is very rare. The vast majority of firms in the world do not pay dividends. Only your large established industrial firms where the executives have nothing better to do with the money than just give it back to the shareholders. Say with Coca-Cola. Coca-Cola sells soda, and they bring in money, and they've tried Coca-Cola Clear, that didn't work. They've tried Coca-Cola this and Coca-Cola that. None of them has worked out very well. So the only thing left for them to do is stand there, turning the crank of the money machine. Money falls out on the floor, and they give it back to the shareholders. Most firms, you want to roll the money back into the firm to grow the firm either through marketing or through research and development, things along those lines. But the common shareholders, because they have the prospect of an extreme growth, maybe, then they're willing to accept that risk, but they also want to have a say in the operation of the company.
Okay. So if you look at Bitcoin as shares, it seems that the holders of Bitcoin don't actually get any say in what happens. There's another type of share in Bitcoin, a share of the hashing power.
Right.
Is that sort of like a difference between voting and non-voting shares?
Seeing as how the 51 attack is based on the idea of a majority of the hashing power deciding whether transactions should be recognized or not, then yes, the payment processors that we still euphemistically refer to as miners, in fact vote. They have the votes. The Bitcoin holders, on the other hand, have something that would be more akin to something that they would call a capital share in Europe, where you own a piece of the equity, but you don't get to vote on the disposition of the assets of the firm. Somewhat similar to a preferred share in the United States with a guaranteed dividend, except in this case there is no guaranteed dividend, so it's more like the European-style capital share, which is basically give us money, sit down, and we don't want to hear from you.
Okay. So you could also apply the same analogy to the dollar. Dollars are sort of like non-voting shares in the economy, and the Federal Reserve is the voting ultimate decision maker.
In a sense, yes. The dollars do not carry the same sort of voting power as the common shares of a firm. So, for example, again, if we're going to look at a government, not the country, not the economy, but the government that is responsible for the issuance of this money, if the dollars are to be viewed as the equity, then you certainly can say that each individual dollar does not convey a vote in quite the same way as people who decry the 1% would seem to mean. Because otherwise that would mean that everyone who has some dollars in his or her pocket would get to decide on whether the country goes to war or whether a bridge is to be built or whatever. And that's clearly not how it works.
Mm-hmm. So a country or a government it sort of has two classes. You've got your voting system for control, and it's separated from your equity or your capital.
Yes,
shares.
For the operation of government, the votes are held by the upper house and the lower house of Parliament or Congress in most countries, and the executive branch will either veto or not veto in presidential systems. In parliamentary systems, it's all done at the parliamentary level. Mm-hmm. So the Congress in the United States, that's where the votes are taken. These are the people who vote whether or not to go to war. These are the people who vote whether or not to allow the government to shut down. These are the sorts of things that they do. The people who hold dollar bills basically sit passively by and wait to see what decision was made.
Okay. So this can kind of be thought of with a traditional company with regular shares. You've got minority shareholders. Say they might have 1 or 2% of the company.
Yes.
They're normally protected. You know, you consider it in the best interest to protect the minority shareholder. And there are laws to protect them from the majority. Just say, you know what, we're going to issue a whole bunch of new shares. We're going to allocate it all to the current one. You now went from owning 1% to essentially nothing.
You're right.
You know, why is that illegal, and how is that similar to currency?
Well, it depends upon the country that you're in. In the countries that attract a lot of external investment from other countries, you will have very strong minority shareholder rights. Canada, the United States, the UK, Australia, all have very strong minority shareholder rights, and the situation is exactly as how you describe. You have other countries, largely in the developing world, where you will see large family-owned combines. So one family will run the grocery stores, another family runs the ports, and another family runs the transportation, another one owns the toll roads. And this is because in those countries they have weak minority shareholder rights, And where the government fails to protect people's property rights, you have familial ties. So rather than going to court, you go to holiday dinner and then you get up in your cousin's face and you yell at him, and then your uncle arbitrates, and then the dispute is resolved. If you're an outsider and you own 1% of a company like that, you have no recourse, at least until you marry into the family. And that's very, very common throughout much of the developing world. This also ties with a related topic, and that has to do with transparency. At the one extreme, as far as regulatory regimes are concerned, you have what you could think of as being over-regulation. This would be a country where you have to ask permission to incorporate, and you have to then justify your business plan with the finance ministry. And you might even have to give them a business plan that they would then review and decide if they need one of those. And of course, what winds up happening oftentimes is if the plan is a very good plan, then they tell you no, that they don't need to let you open this company, and then they front run you, they give the business plan to a nephew who goes and starts your company. Very common. And at the other extreme, and apologies to any libertarians who might be watching, we have a situation where you have either an incompetent government or you have, in fact, no regulation in this regard. If there is a dispute, there is no legal system or no functioning legal system for you to go to, and it's basically every man for himself. So you could think of that as being hard-on quasi-anarchy. Foreign investment tends not to go into places like that because the foreign investors don't know what's going to happen to their investments. In the over-regulated scenarios, you also don't have a lot of foreign investment because you have to ask permission at every turn. You take a look at a company like Nokia in Finland. They started out in wood. They cut down trees and they made wood. And then at some point they moved into rubber and tires. And then later they moved into pots and pans. And then eventually, finally, they moved into the mobile phones that you see now. And the people at Nokia have changed their business model throughout the decades in response to changes in the marketplace. There are some places in the world where if you have registered a company that makes wooden board games, that's what your company does. And you say, oh, well, we decided that we want to do mobile phone apps. Then your business license is void and you're not allowed to do that because it's wooden board games.
I'd like to steer this back toward the separation of control from the shareholders.
Yes.
And how it seems like most of these problems where the minority shareholders suffer result when people making the decisions about what to do with the resources.
Yes.
Ownership is highly tied to control. And it's like they own it and they can use it for whatever they want to use it for.
Right.
But the people who have the shares have no say. They don't actually own it. They're sort of at the mercy of the people who actually control it to a large extent.
It depends upon how you define ownership. And if you equate ownership with control, then the control that you would have if you were the owner of capital shares, for example, is that you could sell them.
Right.
So that would be control of a kind, but certainly not nearly as powerful as voting rights.
Right. So what we're doing with BitShares and all of our decentralized businesses is the concept of proof of stake. And the proof of stake can be thought of as, instead of having two classes of shares, hashing shares and currency or capital shares, you have just one class of share, and it simultaneously conveys control over which transactions get included in the network, as well as securing the network, and serves as your equity or your capital.
Yes.
There are those that don't like Bitcoin as a currency.
Yes.
Because they're trying to compare it to gold and silver, which are the one true currency, don't you know?
Right.
And the reason is because, well, gold and silver are entirely different category of thing. They're a commodity versus a share in a business.
That would be one argument one could make. Yes, absolutely.
Yeah. So when people want to use Bitcoin as a currency, what they're really saying is, hey, I've got 100 shares in Apple Computer. I'd like to go and buy a widget from you.
Yes.
And of course, Apple Computer shares are almost as volatile as Bitcoin,
right,
depending on the day. And so, in theory, you could do that. That's just barter.
Yes.
So if you want to understand Bitcoin, it's like having a global transaction ledger.
Yes.
Where I'm going to sign over my shares to you in exchange for something that you have.
Yes. And if you go back a couple decades, There's a book written by Richard Rahn called The End of Money. And his argument is that because of the debasement of the US dollar and fiat currency worldwide, people have a tendency to hold on to smaller and smaller balances, even to the point now where many of us might not have much or any cash on hand at any given moment because we use our credit cards and debit cards. And his argument was that money, as the medium of exchange, store of value, unit of account, and measure of value, is increasingly being split into many different assets so that the medium of exchange now becomes a debit card or a credit card. And the unit of account remains the dollar, but the store of value is a portfolio of assets. And we will liquidate some of those assets to make payment on some debt or transaction, and then the receiver will then flip those into some other assets. And that is happening so fast that the period of time that many people are holding on to money is vanishingly small. So the idea of going into the store and buying some groceries with a share of Apple stock is not as absurd as you might think. And you might even find yourself handing over, a $600 share of Apple, buying your groceries, and then getting back, some Applebee's and some other companies' shares that have smaller denominations, in the same way of making change with Bitcoin. So the analogy is okay. It's unusual, it's a little awkward maybe, but it's not ridiculous.
Right. So why would someone want to store their wealth in stocks? Everyone says don't store your money in the bank account. You don't get any return.
Right.
Instead, what they tell you to do is you should invest, and you should invest in companies that earn a profit, that are going to go up in value. And why do stocks go up in value? If you think about it, a lot of it has to do with inflation. The dollar is going down in value, so the companies are going up in value.
Yes.
And if you pick companies that are very profitable, they go up in value faster than companies that are losing money.
Yes. And one way of doing that, or convincing yourself of this, is to take the price history of the Standard & Poor's 500 index, and you'll see that it has kind of a sawtooth pattern. And if you then pick pretty much any other asset of your choosing, whether it's the price of gold or the price of silver or any other asset other than a national currency, so you could do it with Apple shares or IBM shares, you see that ever since the early 1970s, the trend has been consistently downward in the Standard & Poor's 500, denominated in anything but dollars. So the point of this is that you'll see the price of your shares going up and up and up, but as soon as you denominate it in anything except for something that's losing value, it turns out that the value of the S&P 500 has been falling. And it would be, actually I have not done this yet, but it would also be interesting to look and see what other, going company by company and seeing how that has played out as well.
Which is very interesting, because when you view Bitcoin as a company, now you've got to evaluate it compared to other companies.
Right.
And if you've got all these different altcoins, they're just like different companies out there.
You could say that, yes.
And you got a portfolio of companies that you can invest in, and how are you going to evaluate it? We want to look at their profit and loss statements.
Right.
What are their expenses? What's their business model going into the future? What's the value they're providing the economy? Can people live without it?
Yes.
So if you could use Apple stock like you could use Bitcoin, then why would we need Bitcoin? Right? What makes Bitcoin special?
Well, several things. One is it's very easy to transfer. Technically, one could create bearer shares of Apple and exchange those, and it is also conceivable, although from a regulatory standpoint, I could see setting up a system that would enable people to do this. I would hesitate to do this myself. I'm an American, I live in the United States. So as a purely theoretical thought experiment, one could create a one-to-one proxy for Apple shares, and you actually could use those for money if you had a counterparty who would accept them.
Yeah.
Again, it's not likely, but then again, stop and think about it. Who among us actually has ever seen anybody ever use silver dimes as hand-to-hand money? Who among us has ever seen anyone use a Krugerrand to pay for groceries or buy gasoline? We talk about it and we theorize about it, but we don't actually see it happening. Hand me a Krugerrand, I'm not giving it to the grocery store. I'm going to hold on to it. I'm going to drop it in the drawer and I'm going to just hang on to it. But there are some small subgroups where the people will in fact transact hand to hand with something that represents either gold or silver. We saw this with the Liberty Dollar. People were actually doing hand to hand transactions with silver rounds. There is no reason to assume that it would be impossible for some Apple fans to want to use Apple shares as their medium of exchange on their websites when they're buying and selling apps or whatever. In fact, it would make complete sense to sell iOS apps for Apple shares, come to think of it.
Yeah, there you go. So what makes Bitcoin different is that it's relatively easy and secure to transfer the shares and to authenticate it. And that if you could do that with a traditional company,
well, also Bitcoin is very hard to counterfeit or to dilute.
Exactly.
So Apple shares can be diluted at the whim of an executive, whereas Bitcoin is diluted at a known rate, and we can predict with fair accuracy how many Bitcoins will be in circulation at some point in the near future.
But assuming, just for the sake of argument, that you could trust the Apple executives, they've made promises that they weren't going to do that.
But with Bitcoin, you don't need trust.
Right. This is a benefit of Bitcoin, is that you don't need trust.
Yes.
But you could use the analogy that, well, if one of these companies were to set up and make it really easy for people to trade balances between one another, just like Bitcoin, just like a web wallet, they could send the shares, that there's no reason why people wouldn't trade them like they do cell phone minutes.
Well, that was Richard Braun's point in the End of Money. Absolutely. And if that experiment didn't work, then somebody else will run a different kind of experiment. And whether the currencies, however defined, whether they're backed or unbacked, whatever.
Right. So let's get back to the crypto realm for a minute, because what we're trying to do is take all these lessons and build better crypto companies. These are companies that are not legal entities. These are abstract, they're autonomous, they're just software, no different than Bitcoin.
Right.
But their business models are coded into the software. And what we try to do is make them profitable in the sense that over time we want to increase the amount of equity you have in the business per share in the business that you have. And that's one way of doing it. And so we take the transaction fees that Bitcoin charges. And instead of paying them all out to the employees, the miners, we use them, you can think of as stock buyback. You buy it back and retire it. Therefore, you take it out of circulation, value of the stock goes up. It's like Apple buying some of their shares back recently.
And the interesting thing with that is that the buy and hold investors are rewarded for this, because if I buy 100 shares of Apple, and that represents, hypothetically, 1% of the firm, and then the people who are busy doing high velocity trading are paying a transaction fee at each turn, every time one of those transaction fees is taken out of circulation, my 100 shares becomes a larger percentage of the firm. And the people who favor inflation like to point out that a little bit of inflation gets people to spend money in the present when they normally would not have done so. However, it is not that long ago that our parents and grandparents were counseling us to save for the future. And somehow in the past 4 decades, that's been turned on its head. Whereas taking the fees out and either retiring them or burning them, whatever you call it, gets us back to a time when people set aside capital for the future. And that seems to make more sense.
Well, people already tell you that you should invest. And they say, well, you shouldn't save dollars. You should spend dollars, and you should invest in something else, like equities.
Right.
Stocks, they're back to the whole premise of they're going up in value, and people don't want to trade them. You want to buy and hold stocks. So the advice is still buy and hold. But the asset that you buy and hold is switched from money to stocks. And there's a very simple reason for that. Money is losing value.
Precisely.
And stocks aren't. So it makes perfect sense. But the story that money gets its value from being transacted is the lie or the myth that gets its value from being held. It's the demand for the money is what gives its value. If no one wanted it, that's hyperinflation. If everyone decided that money is worthless, poof, it's hyperinflation. So when we replace proof of work with proof of stake, we're giving control back to the shareholders and simultaneously making a company that's at its foundation profitable. And then what we want to do is implement different business models. that provide different services. So if you look at Bitcoin space, you've got Bitcoin, Litecoin, Dogecoin, all these different cryptocurrencies. It's like having 100 different companies all trying to do the same thing.
More or less, yes.
They're all trying to sell you their shares for use in trade.
Yes.
And that if you use their shares for trade, they make money. If you use someone else's shares, the other company makes money. But you'll notice that every single one of these companies out there, these crypto companies, is debasing their shareholders. They're issuing new shares every single block. Although a couple of them have gotten to the point now where they've mined all their currency into existence, and they're now at the break-even phase where they're paying all the transaction fees to the employees. Well, that's a lot better. That's an improvement.
Yes.
But what we're trying to go the other way, where we want to take as much out of circulation as we can while still being competitive in the market.
Right.
Obviously, we can't just charge obscene transaction fees.
Right.
Or no one would transact on our system. So there's market pressure, market forces that drive down transaction fees. That doesn't mean that they can go all the way to zero.
Right.
Because otherwise you'd have spam. So some of the businesses that we can do, if we can come up with other models other than, hey, I've got some shares, I'll transfer them to you.
Right.
That's valuable. We can now trade shares. That's the difference between owning a share in an Apple computer that you can trade and owning a share that you can't trade. One's more valuable than the other.
Right.
So let's look at other things we can do. We've got so we're creating BitShares X, and you start out with a company. It's a bank and exchange is what we're trying to do, and we want to implement a similar business model to an existing bank, and in doing so, do it entirely on a blockchain. But in order to understand how BitShares X works, let's first review how a bank works. The thing I want to convey with BitShares X is that if you have a bank, what does a bank know? It's an IOU from the bank. Whether the bank actually is able to honor that IOU is a completely separate matter. But people trust the bank more than they trust you.
Right.
So the bank knows, the bank has collateral backing every one of their IOUs. And people know the bank has a lot of money, so they trust the bank. So in theory, you could buy something and say, hey, I owe you $10. Here you go. And you walk away with it, or $20,000, here's a car.
Yeah.
But the car dealership isn't going to accept your IOU because who are you? So you go to the bank and you say, hey, here's an IOU. I owe you $20,000, Mr. Bank.
Yeah.
Here's the car I'd like to use as my collateral. And the bank says, okay, here's an IOU from the bank. And you give the IOU from the bank to the car dealer, and the car dealer, sure, I trust the bank. And what does the car dealer do? They go over to the bank and they have a deposit with the bank.
Right.
And so the bank never actually has to have any dollars as long as everyone trusts the deposits of the bank to mean something.
Sure.
And that's where I was trying to go with that.
Okay.
You can have a regular company, a legal entity, if you will, that can lend dollars into existence, just like that. An IOU from, you go register a new company, My Company, Inc., and you can write someone an IOU from My Company, Inc., and give it to someone, and if they accept it, great. It's an uncollateralized IOU from the bank. Now, if the only time My Company, Inc. issues an IOU is in exchange for someone else issuing me an IOU with collateral that's worth much more than their IOU, then as a bank, I have rights to $200,000 worth of collateral.
Right.
An IOU from someone owes me $100,000, and I owe someone else $100,000.
Very good.
As long as my collateral is liquid, and at any time, if you come back to me and say, hey, I demand the bank pay the $100,000 that it owes,
right,
and the bank can say, all right, well, I can go and turn to the person who I lent the money to and say, I demand you pay me, and they can sell the collateral if they don't. Such a company could exist today.
Yes.
Now, the interesting thing is, well, what if the collateral was not a house or a car, but hey, My Company Inc. has a bunch of shares.
Yes.
And you own shares in My Company Inc. So I say, great, I'll lend you $100,000 as long as you give me the shares, and I know the shares are worth $200,000.
Okay.
And I can sell these shares at any time because there's a market for the shares in my company.
Right.
So it's really no different than something that you could do with a traditional business,
Mm-hmm.
except that we've used a crypto business.
Right.
And it's all implemented on a blockchain.
Mm-hmm.
So by being on a blockchain, you don't have to worry about transferring shares. That's handled.
Right.
You don't have to worry about the collateral or foreclosing on a house or a car,
Mm-hmm.
because the blockchain can control the sale of the collateral. So you get the exact same business model as a bank.
Right.
So we've just created a whole new valuable service.
Yes.
So we just got done describing how a bank can lend money into existence on collateral. And we've made the analogy that BitShares X is like a banking exchange.
Yes. And of course, a bank is not the only organization or person who can take collateral for a loan. This is just one example of many that function in this particular way, but it's one that people are familiar with in their day-to-day lives.
Right. The banks are the ones that are generally trusted. Everyone's using the same bank,
Yes.
and they all trade the bank's IOUs
Mm-hmm.
as currency. If you think about it, that's what money has been for 100 years,
Yes.
Or 200 years. It used to be every bank issued their own currency,
Right.
and sometimes, based upon people's faith in banks, they'd have different exchange rates
Yes.
based upon the likelihood that the bank actually has the reserves and is able to make good on their promises.
And anybody familiar with the Christmas movie, It's a Wonderful Life, you can see what a bank run looks like.
Right, and so what you're circulating are these bank notes.
Yes.
But
Many people don't know this, by the way, and that is that when you have a deposit at a bank, that is a liability of the bank. It's debt. The bank owes you $1. When you walk into a bank and you give the bank $1, you now have $1 on deposit. But when you go back, if you look at the serial numbers on the note that you get, it's not going to be the same dollar bill. They owe you $1. That's your deposit. This is something that people in the general public oftentimes, I would say almost always, don't even realize, that the bank's asset is the dollar that you handed over, and the corresponding liability or obligation or debt is that they owe you $1, and those two have to be equal. So yes, you're right. What you're transferring is IOUs. It's debt. The bank owes you $1, and somebody else owes somebody else $1, and even the dollar bills themselves are IOUs from the central bank.
Right.
And so we're all just swapping around these IOUs.
So back when we went off the gold standard, it went from IOU an ounce of gold to an IOU nothing, but people still accept it because they owed other people dollars.
Right.
And so they continue to circulate. But the reality is that even though we're calling it a banking exchange, it's only a bank in the sense that you have a balance on a blockchain, on a transaction ledger. And it's not a bank in the sense of being a legal entity. There are no vaults.
Right.
It is just a means of tracking IOUs. Or in this case, what makes BitShares X different from Ripple is that BitShares X tracks collateralized IOUs.
Very good.
Whereas Ripple tracks uncollateralized IOUs. So if you look at the Ripple system, it's great. You can move dollars through it, but you also move defaults through it, because when an individual extends credit for so many dollars to their friend, and the friend dies, all of a sudden there's a default, and there's no way to get that. With BitShares X, well, I'm going to extend you $1, but there's going to be collateral held in the blockchain that prevents. I don't have to worry about you defaulting because there's collateral, and if the price changes against it and you can't honor the IOU, then the collateral will get sold and I get my value back just fine. And the other thing is that in Ripple style system, the IOUs aren't fungible. An IOU from friend A is different from an IOU from friend B based upon their credit rating. But in this case, we swapped all IOUs with the bank.
Right.
And therefore they're fungible because they're all an IOU from the system instead of...
It also has an interesting side effect, and that is that the underlying currency within the system, the underlying BitShares, is that within this system, the highest and best use of the BitShares is to be locked away as collateral. and then the items that are circulating are going to be more familiar things. With Bitcoin, we have the unfamiliar things circulating, and look at the price charts. In fact, it's silly during this kind of conversation to mention the Bitcoin price in US dollars, because anybody watching this 6 months from now, the numbers don't match up with anything in their day-to-day reality. But I just saw the price go from where it was yesterday up by about 16%, pretty much in front of my eyes during a conference call today. I haven't checked the news to see what happened, but people are still trying to figure out what this stuff even is. Now, I understand the technology, and I explain to other people. I've had several media appearances. I get what it is, but what is it at a higher level is a bigger question. With the BitShares, you're locking them up as collateral, which is what I would do with Bitcoin, by the way, and have something else circulating against it that we're familiar.
Uh-huh.
And that is one of the things that I find most exciting about BitShares, is you've got the altcoin, but it gets locked away, and then it enables the circulation of other things that are bound only by your imagination.
So we can have BitUSD, which is a digital asset
Mm-hmm.
that's got all the properties of Bitcoin,
Mm-hmm.
but it's got the price stability of $1.
Right.
You could do it for euros or gold, silver.
Mm-hmm.
But there are some limits to what things are feasible at this point in time,
Yes.
based upon market depth.
Yes.
Could you explain how?
Oh, well, if you have three people sitting around a table trading some good or service, there's not much of a market there. If one of the three wants to sell, maybe the other two don't want to buy, and so nothing happens. You need to have a large number of transactions taking place, and you need to have a large number of individuals who want to either buy or sell, or potentially buy or sell. That way, if a person wants to get into the market, then there's going to be somebody on the other side of that transaction.
Mm-hmm.
If you try to jumpstart one of these markets and it's very, very, very thin, then you wind up getting these really wild rides while people try to figure out what's going on. Or alternatively, what you get is nothing happening.
Mm-hmm.
Imagine for a moment that all of the Bitcoin in the world were held by the Winklevoss twins and, I don't know, Eric Voorhees, and pick some other people. And they're all sitting around a table together. They're all staring at each other, no transactions take place. Or if you go back to the early days when the first price for Bitcoin was discovered, and it was, I forget what the number was.
10,000 for a pizza.
Well, yeah, but even before that, it was like thousands for a penny or something. And the price would change wildly with each transaction. And what you need is to have a large number of individuals. You need to have a large amount of value in circulation, and then no single transaction will represent a significant proportion of what is possible in that marketplace. So if I were to buy Apple shares, the price isn't moving, not from my purchase.
Mm-hmm.
And then if I sell them later, the price is not going to move from my purchase. But even today, if you go to Bitstamp and you buy $10,000 or $20,000 worth of Bitcoin, you can sit and watch the price move.
Right. So when we create these BitUSD, we create a market where some person borrows and sells it into existence, and other people take the opposite side of that position
Mm-hmm.
by buying it. We need to make sure that there is a large enough market so that the price doesn't move too much by any single transaction,
Mm-hmm.
and that you can reach consensus.
Mm-hmm.
If you think about the true technology behind Bitcoin and this entire system is consensus. And what people don't realize often is that prices are a way of the market reaching consensus about the value of something
Mm-hmm.
on a global
Yeah.
scale. So
Yeah, the price is what splits the optimists from the pessimists. You have a bunch of people who want to sell, you have a bunch of people who want to buy, and whenever the prices cross, you have a transaction. An interesting thing about this also is that prices are based upon disagreement. I think something is worth one amount, you think it's worth another amount. Whichever of us thinks it's worth the more is the one who's likely to buy, and the other one's going to sell.
So, yeah, what I suspect is going to happen in the future is that as more and more people get used to the possibilities of pricing this, we get more and more market participants.
You keep talking about a BitUSD,
Yeah.
presumably $1.
Mm-hmm.
So where are the dollars stored that back this thing?
Well, a BitUSD is you can think of it, let's use gasoline. You can have $1 worth of gasoline.
Okay.
Right?
Yeah.
But if you drive by a gas station, you see the price is constantly changing.
Mm-hmm.
So imagine you've got 10 jugs with gasoline in it,
Mm-hmm.
and every day, magically, the amount of gas in each jug changes, so it's always $1 worth of gasoline.
Okay.
Right? With blockchain technology, we can do that type of thing.
Mm-hmm.
Well, now if you want to go buy something from someone, you can say, hey, here's a magic gallon of gasoline jug, and you can give it to someone, and they'll accept it as $1 because they know at any point in the future there's always going to be $1 worth of gasoline.
Oh, interesting. So a bit USD is $1 worth of something else.
Yes.
But so there's no bank involved. There's no dollar involved.
It's $1 worth of shares in the BitShares X or the bank or whatever entity is issuing the derivative, if you will.
Interesting.
So. So we've covered the whole spectrum. I hope that what people can get out of this is that $1 is just a share in your government, or a Bitcoin is a share in the Bitcoin virtual company, if you will, and that by changing the analogy, it's no longer so obscene to see that Bitcoin has value and how it can be traded. So the gold bugs who appreciate stocks can understand that, hey, Bitcoin, BitShares, they're just a stock. They're providing a service. It's going to be volatile, but it has value.
Mm-hmm.
And
which is why you coined the term distributed
autonomous company.
Company, yes.
Yes. And the reason why we say distributed autonomous company versus organization or application is because the company analogy is so fundamental to understanding how to actually build these things and how to do stuff with it. What's an organization? Well, an organization is a group of people that try to do something, but it's not clear if they're trying to make money or if they're just trying to give money away or just want to hang out.
Social club, yeah.
Yeah, but a company has a clear vision or purpose generally, which is to produce more value than it consumes in producing it, and therefore make money for the shareholders.
Mm.
And if you think about it, all living organisms need to do that. If you require more energy to keep going, anyone who's unable to produce enough value in society
right.
To cover their food
yes.
and their housing,
mm-hmm.
they eventually die. Any organism that's unable to go and produce enough food by hunting prey or
mm-hmm.
or a tree that's unable to collect enough sun is going to die because it needs that much just to keep its life
sure.
systems operational.
Sure, and companies need to take in more in revenues than they spend in expenses. Governments need to take in more in taxes than they spend, or at least have the books match exactly, but they have to take in at least as much. If you're running a church, you need to take in at least enough to cover your various expenses. It doesn't matter what the economic organization is, it needs to take in at least as much as it spends.
But no, this is all very critical, and when you analyze things from this perspective, you realize that there is no magic. Inflation is nothing magic. It's just another way for the government to take in the value it needs
mm-hmm.
from society at large in order to keep funding its operations.
Yeah.
So value is always transferred,
mm-hmm.
and by calling it a decentralized autonomous company, we're really trying to highlight three critical points. One, it's decentralized, which means there's no single point of failure. This is not a proxy for Apple Inc.
mm-hmm.
issuing Apple shares in a regulatory sense. There's no legal entity backing these shares, or
mm-hmm.
where it's entirely decentralized, such that you can take out any person or any group of people, and it'll continue to function. As long as there are two people that want the system,
mm-hmm.
anywhere in the world it can continue to function.
Mm-hmm.
That's decentralized. Autonomous means that you don't have to have anyone running the company.
Mm-hmm.
People transact, they interact with it, but it's all done by software.
Mm-hmm.
And then by a company, we're really capturing the fact that it does have a profit motive.
Right.
And